Democrats are taking aim at Wall Street with their new financial transaction tax, but how will that affect the everyday investor? Joining us now for more on this is the president of Diversified Private Wealth Advisors, Dominick Tavella. Dominick, thanks for joining us this morning.
Good morning.
Good idea, bad idea? Let's start there.
Well, anytime you're increasing taxes and you're increasing taxes to the average person on the street, it's a bad idea. So this is another one of those, let's find some excuse whatsoever to find a new tax, figure out that it's really not going to hurt the average person on the street, and it actually does.
And how does it hurt the average investor, Dominick?
Well, it's all about fees, right? So if you're looking at a typical mutual fund, a pension fund out there, CalPERS, the retirement system in California, or the New York State retirement pension system, they're trading stocks, they're trading bonds, they're managing a portfolio for their retirees. They're managing portfolios for their shareholders in the case of a mutual fund. So anytime there's a transaction cost, somebody's got to eat that cost. That's part of the operating expense of that, whether it's a mutual fund or the pension system or trust account. That cost gets passed on to the beneficiaries of those accounts. So if instead of getting a lower cost operating entity, they're getting a higher expense that either comes out directly in a fee that they pay, or it comes out indirectly in the asset management charge that they pay.
Also, you know, it could hurt businesses too, right, Dominick? If you think it through, you know, businesses trying to raise capital, it could hurt them in that sense. Businesses that want to expand and create jobs.
Look, we haven't seen the final language. We're only getting bits and pieces of it. Some of it they're saying they might not cover. They might not initially impose this tax on IPOs. So it's possible some of the initial public offerings might be exempt from this. But I look at the everyday 401k participant, IRA, their fees, their costs are going higher. Their total return is going lower. And at the end of the day, it's just about raising revenue so that they can go and spend it on some pet project.
And very quickly, Dominick, but on the other side of the argument, they would say this tax over the next 10 years would raise $777, I don't know how they come up with that number, $billion, which would put a nice dent in the deficit. How would you respond?
Well, if they target it towards the deficit and instead it can only be used for the deficit, if they target it for Social Security, which we know is going to implode down the road, or Medicare, then you could argue, okay, there's a real benefit that the average person on the street is going to come out of this. Right. No, this is going to go for windmills or some other project that at the end of the day will be more wasted money.
Yeah, goes into the great abyss, as they say. Dominick Tavella. Dominick, thanks for getting up with us this morning. Appreciate it.
Thank you.